everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Travis Watts. Travis is a full-time passive investor. He has been investing in real estate since 2009 in multifamily, single-family, and vacation rentals. Travis is also the director of investor relations at Ashcroft Capital. He dedicates his time to educating others who are looking to become hands-off in real estate. And Travis has reached a financial independence through passive investments. So I'm really excited about this interview because we get to really understand how Travis' journeys are reaching to his FI and maybe share some tips on investing. Welcome to the show, Travis.
Hey, Elisa, thanks so much for having me. We were kind of chatting offline and we just have so many similarities. We're both passionate about teaching people about FI, financial independence, the 10-year time frames. I always like to tell people, it's a for a while thing. It doesn't have to be a lifetime thing when we talk about frugality or sacrifice or things like that. But yeah, happy to share my journey and hopefully it's helpful.
Yeah, definitely. So Travis, we always ask our guest, like thinking back in your life journey, who or what incidents kind of really give you the most impact shaping the entrepreneur person that you are today?
Yeah, I would say starting back from childhood. So my parents split when I was 5 years old. And so on my mom's side, we had a lot of entrepreneurs, just small business for the most part, various types of businesses from delis and even a septic business at one point and just different things. And so I learned a lot there. And from both of my parents, my dad's side and my mom's side, I learned a lot about frugality. So I learned a ton about using coupons, live below your means, buy the off-brand, don't spend money on things you don't need, eat at home versus restaurants. There were so many of these things, which to an extent, they were very useful and very helpful. I use some of them today, but also to an extent, it can become sort of a scarcity mindset. And so what I've had to self-educate on is the investing side of the coin and the multiplying your income and your revenue streams.
Yeah, that's amazing. So Travis, like you follow the kind of the normal passes, got a day job, and essentially now become entrepreneur. And then you mentioned about the frugality. I think that's so important because mindset is really about everything. Mindset is really about everything. If you change that and become more abundance mindset, you can become pretty successful. So what did you do that helped yourself to kind of unwind that scarcity mindset that you said before?
Like yourself, back when I was introduced to the Robert Kiyosaki books, believe it or not, though, I didn't start with Rich Dad, Poor Dad. It was a total coincidence. I was visiting my dad one summer in high school, and I was into like reading, I guess, just reading my own kind of stuff that summer. And I was having trouble picking out what interests me. I really didn't know. And he was out at a garage sale, my dad, and he comes home with Rich Dad Prophecy, which was, I don't even know, like the fourth or fifth book of the series or something. And it was totally out of my wheelhouse. Never have I, at that point focused on finance or investing or the stock market. And so that was a huge eye opener. And the real takeaway I remember from that book was just stay out of the stock market, and then maybe think about real estate. It was a very high level kind of book, just saying there'll be a stock market crash, not necessarily a real estate crash per se. Ends up, we kind of had both. But
Right.
I took the advice. I wasn't in a place to invest anyway in high school, but I just put that nugget of information in the back of my head and said, all right, fine, I won't be in stocks. So all the money I would save from working and, landscaping, mowing people's yards, I had a paper route, I did all kinds of different things for income, little small business ventures. I just put it all away in cash for a while until I had enough to decide, okay, now I need to do something with this cash. And, call it luck, I guess, or call it when preparation meets opportunity. But, the Great Recession happened and I had a little bit of cash to invest. And that's where I decided to jump into real estate. In my market, prices had fallen about 40%. Government was giving out a first-time home buyer credit. And I thought, it's now or never. So I had to take a leap of faith. Not that that was easy. I was scared to death, by the way. That was like all of my net worth
Yeah.
put into a house, but it worked out.
Yeah, that's fantastic. And obviously, success kind of motivates people to continue, rinse, and repeat, do the same thing
Yeah.
on that. But speak of which, you shared with me before that. So let's kind of gone through the journey a little bit more. Like you probably went to college, you probably got a job, W-2 job. At some point, you mentioned that you have potentially opened 20 businesses at some point. So how did like that happen? Like, was
Yeah.
it during your W-2 job you started doing some of that? Like, how did that happen?
Yeah, good question. So, like I mentioned, through my mom's side, it was a very entrepreneurial upbringing, and I spent a lot of time around my mom and around family. And so, I was just excited out of the gate to do my own thing. So, I never went to go get a job initially. I went to go mow neighbors' yards, and I was an entrepreneur making whatever, 10, $15 an hour or something. And then that moved on to, I started detailing cars. So, waxing them, washing them, cleaning them up. That led to getting into exotic cars, on a neighborhood nearby where people had a lot of wealth. And then that actually led to detailing small aircraft, small planes, things like, Cessna planes and stuff. And so I really started kind of that detailing business, and I went to school for something completely unrelated. I went to school for live show production and audio mastering and video production. So I was going to get out on the road with bands. This was like my big dream. Move to Nashville, go to New York, go to LA, and do this big stuff, until I did my internship in New York City for an off-Broadway production, and just realized, wow, that's not a path at all that I'm interested in.
Yeah.
And thankfully, I had only gone a couple years to school at that point, had an associate's, and just thought, I'm going to pull the plug and do something different. I'm going to 180. And I ended up in the oil industry, long story short, out in Colorado. So crazy circumstantial changes. But back to your question. So through high school and college, and then post-college, about a year and a half, I had launched over 20 small businesses, from audio mastering and a small little recording studio, to renting audio equipment out to DJs and bands locally, to the detailing business I mentioned, so the list goes on and on. But long story short, I didn't really have the skill set to manage and expand these businesses. And they all ended up failing except for my real estate venture, which started with a house hack. So that wasn't a term back in the day, but I just bought a 2-bed, 1-bath in a college town, lived in it, rented out the spare bedroom, fully furnished. That actually paid my mortgage, believe it or not, just that rent alone. So I was living for free, post college. And to your point of motivation, right? It takes that spark and that momentum. That
Yeah.
was mine. That was my momentum.
That's amazing. And then that is actually amazing because you basically have nothing to your name and you just put all your money into the house, took a
Yep.
leap of faith, and then but you knew that somehow the cash flow number all kind of works. Now, I wanted to kind of dive into this 20 businesses, this whole shebang of like going everywhere. So it's very interesting because with a lot of entrepreneur mindset, we are very creative. So we tend to say, oh, we can do this business, we can do that business, and all that stuff.
Yeah.
Hindsight, would you think some of these business may be successful if you like reduce the focus, or like what would you differently over here for that particular span and these 20 businesses?
What I failed to have in my mindset back then was that building businesses sometimes is a numbers game, right? So I think we all know the business failure rates, et cetera. So I was quick to pull the plug back then. I had limited capital to work with. I didn't really have the connections to help me grow and expand, and people putting capital into these businesses. So what I would do is I would work, I would save, I would have, $3,000. I would go launch a business and spend the 3,000. And then as soon as I hit a hurdle, I'd go, oh crap, I got to shut it down because I don't have any more money to put in this business. And so I would just lose all my capital and give up early. So a lot of these, as you can imagine, in that time frame, just several years, they close shop pretty soon, anywhere from a month to maybe 9 months, we'll say. And so that was probably the biggest mistake, is just realizing, business 1 may fail, business 2 may fail, 3 may fail, but eventually you strike something that works, just like with venture capital investing. Not every deal is going to pan out. You listen to people like, Mr. Wonderful from Shark Tank, and he's putting 100K in all these businesses or whatever. And then he's saying most of these, in fact, are going to fail. But occasionally I'm going to hit that business that returns me, 1,000% return on equity. So that's kind of what I failed to have mentally back then.
Gotcha. And the capital and the connection you mentioned
Mm-hmm.
are very important elements. So onto the real estate. So you did a house hacking, and that you're kind of basically living for free and probably now having some income in there. So how did you generate the income to kind of continue fueling the investments?
As soon as I bought that house, as soon as I got that government check for first-time home buyers, as soon as I put a tenant in there and I was paying my mortgage, I really got the bug. And all of a sudden, this Robert Kiyosaki philosophy starts flooding back in from years ago. I started reading more and more books, and I made a decision. I will be in real estate. This is the one thing that's working for me. Nothing else has. I'm doubling down. And that was something a mentor told me long time ago, years ago, but after this point in my life, is double down on what works, for you. Just double down on what's working for you. And I wish I had that advice from day one. But anyway, so what I ended up doing from there is I got a job, W-2, oil industry, 100-hour work weeks, mostly out of state and out of country. I worked in Saudi Arabia and Kuwait for a while. So I was always away from home. I was burning out literally by the day. It was very tough, but I did this for years. And, this was what I would call my highest and best earning potential at that point for what resources I had. And so ultimately, this was a 6-figure job. And I drew back from my upbringing in childhood, this frugality mindset. And I'm eating ramen noodles. I'm doing $6 a day for food, period. So $2 per meal, 3 meals per day. I'm really being an extremist, and I'm putting back like 70% of my paychecks into real estate. So I got into house flipping. A lot of people probably enter that way just thinking that's the only way to be a real estate investor. And so I wasn't good at it. That was kind of my mistake there. But, I did some successful flips, and then I got into vacation rentals, and I kept doing the house hacking. And I had a multitude of strategies, plus the frugality element, plus being single, no kids at the time. And so that kind of built up a nest egg over about 6 years, maybe 7. And that allowed me to then pivot and switch gears into passive investing, which is what I do today. So in 2015, I had more passive income than I had lifestyle expenses, and I wasn't being so frugal at that point. And so I could live an actual lifestyle of sorts and travel and vacation and see family. And so what I do today is I invest in multifamily syndications as a limited partner, and I still get the tax advantages. I still get the cash flow. I still get to use leverage, but I'm not having to do all of the work, manage the tenants and manage the assets per se. So I've kind of built a little real estate fund of sorts of my own. And that's kind of what I manage today, if you want to look at it from a business perspective.
Yeah, that's amazing. That's awesome, because a lot of people listener would say, hey, I have a W-2. Oftentimes they get paid, quite a bit money. But there's also this and that. I couldn't get it started. That's a hard 6 and 7 years, Travis. By going to the oil industry, you're right, like working 100 hours, burning out. What kept you going? Is there like any tips or any things, routines that you do kind of kept you going with the goal in mind?
I think, it's a great question. I would say self-discipline went a long way, willpower / self-discipline. The oil field is like a very cutthroat industry. First of all, it's boom and bust. So even if you're the best employee, showing up every day, doing everything you can, and then some, you're probably going to get laid off anyway when oil crashes. That's just how it goes. Talk to anyone who's 20 years plus in that industry. They've all been laid off. So in that regard, it's kind of cutthroat. And also it's cutthroat because I felt like there was no cushion. It was, you show up late, you missed the boat. We all left already and the trucks were gone. You can't go drive yourself to the oil site or whatever. Right. So there's really no excuses, whether you're I mean, if you're deathly ill, I guess there was probably some benefits for that. I never had to call in sick, but so having that self-discipline and having to rely on yourself every day to set an alarm clock for 3 a.m. and say, all right, up and at 'em, let's go hit it hard,
Mhm.
taught me a lot just about life in general moving forward. And it goes a long way. We all know, right, half the battle showing up.
Mhm.
That's very true. I would say that's probably more than half the battle, because a lot of people just will soften up or flake out or get comfortable, and then it's hard to take action at that point.
Yeah, absolutely. And so you did a couple house flipping. I guess they were somewhat successful on some project, maybe not so much. Can you kind of explain a little bit about, how is that different, and why did you decide to do passive investment with multifamily or passive investment at all,
Mm-hmm.
compared to what you were doing more actively, like house hacking, long term, short term rentals, and house.
Yeah.
Yeah.
Yeah, I think what I was missing is the perspective, or the resources rather, to know that I had choices. A lot of folks who don't read the books like you and I have read, the Kiyosaki books, they don't network, they don't listen to podcasts like this, and then all of a sudden they get this bright idea, I'm going to be a real estate investor. I think the first thing that comes to mind is buy a single family house. And then what? Flip it. I don't know. And I see this pattern happen over and over. That was me. That was very naive. And because I didn't have teams built, I didn't have, special off market connections to find great opportunities. I'm certainly not a handyman. I was flipping my first house, and I was having to pull in friends and family to help out. My mom was there helping me flip this house, and she's upstairs and she yells down, "Hey, can you bring me the electric drill?" And I thought, I don't have an electric drill. It was that amateur. It was totally amateur hour. And this took me several years to let go of the idea and to recognize that there was alternatives, that I don't have to do all this myself. If this really isn't my skill set, nor did I enjoy it, by the way, no aspect of finding these deals and flipping these deals and putting tenants in deals, none of this process was appealing to me. Every minute of it was like, oh, I have to do this tomorrow. Oh, I hate it.
Yeah.
And, take off work to go to a closing. So it was really the self-education that saved me. In 2015, something really unique happened in my life. And I was working in Saudi Arabia, and I had an equal time off schedule. So it was like 35 on, 35 off, talking about days. And so I had like a month off at a time. And I took advantage of that time when I was home to just study nonstop. I mean, I'd wake up at 7 a.m. I'd read a book cover to cover by 5 p.m. that night, and I just got super motivated. And then I started networking with people, and then I started to realize that there are these hands-off investments, these passive investments, and man, was that a game changer for me personally. That's what allowed me not just the financial freedom, but the time freedom to pivot from the oil field to other things of interest, where I could work 40 hours a week and do things that I actually enjoyed. So that's kind of how that went in a nutshell.
That's amazing. So, how did you actually find people? I mean, people always, because real estate is a networking game, really. Like,
Yeah.
is a really make a big difference.
Hmm.
So how did you like first start stepping out of your comfort zone, or because you're not exactly a social being, because you have to
Yeah.
work 35 days in a row somewhere offshore, and oftentimes in our friends and family group, we don't
Hmm.
really have a ready investor that's already there. So
Yep.
how did you like? Can you share some of your tips of finding people? Uh,
Yeah.
when you first started.
I started with two things: local real estate meetup groups, just something that I searched on Google and found. That was one thing. And then I got into these small little seminars. And so I started attending a local seminar. Then I got to realize, well, hey, there's a really great seminar, but it's in Texas, So then I would start doing these national seminars. When I got to that national level, things really started happening, because you've got all these sponsors and these booths and these people up on stage, and there's 1,000 people there. and you really start networking at a very high level, meeting a ton of people. And then the second thing I did, and it's funny that you mentioned, like comfort zone and introverted. Man, you wouldn't even believe, literally, you wouldn't even believe how introverted I I was back then, and I still am for the most part, despite doing podcasts like this, and I do speaking events. But in my personal real life, I'm very, very introverted. So it was tough for me. This was, I'm sharing kind of what I did. So bigger pockets, for example, online forums, that was really what I wanted to do full time, but I just wasn't gaining much insight or traction there. And so it was really pushing myself outside my comfort zone to do conferences mainly, and that's how I networked and met a ton of sponsors. By the way, I've invested with 14 plus different sponsors, almost 40 deals as an LP. And a lot of these folks came from meeting face to face at some, Los Angeles conference or something like that.
Wow, 14 and 40 deals. That's a lot. That's a lot. You're probably like at the
That's
top.
only the beginning. That's only the beginning. Let me tell you a quick story on that though. This is what opened my mind to that. So I was in this real estate meetup group in Boulder, Colorado. There's about 400 accredited investors in this group. This was years ago. So I got invited to go to one of these, and I was introduced to two gentlemen at this group. They weren't presenting. They had done the sell. What happened was one was in his 60s age wise. One was in his 70s, I believe. And in the mid 90s, they each had sold their companies and made millions of dollars, and they had never intended on, that wasn't their business plan or model. That's just what happened. So they became investors kind of overnight, made a lot of mistakes, put money all over the place. Some did great, some did bad. And so they'd launched this meetup to kind of help coach other people on what to look for and how to vet deals and blah, blah, blah. But bottom line is they're both full-time LPs. They do nothing as far as an active business is concerned anymore, or they haven't for years or decades. But they had done over 150 LP deals in the multifamily sector, just period, just that sector. And that's when the light bulb went off. I could do that. I could be that person one day. I don't know about selling my business for millions because I don't really have a business to sell, but I could scale to the point of being an LP in 150 plus deals. And that's the path that I chose to be on. And that's what I want to help be a voice for, because these folks are not public figures by any means. So I'm kind of out here sharing how that works and what that looks like.
That's amazing. So oftentimes when people reach out, people kind of see a path. There's many different reasons why people passively invest. There's ways to, maybe this is a beginning step to get into the more active part where they become an educator, or simply getting passive income, and many other, like getting educations on, and then this and that. But I've not met many people who are like religiously like 150 LP on multifamily myself, for sure. Certainly a very interesting path. So I got to ask about, what is your cadence, right? So when you first start, like describe to us when you first start investing. I'm assuming you spend 1 year or 2 years to just get educated. Again, kind of like maybe not like super just jumping headfirst, because it sounds like you are someone who's going to think about it for a minute before you jump it into something. So how does that kind of like transition happen? Tell me a little bit about your first deal, the ongoing mindset that is changing for you to get into the first deal. And then subsequently, how did you actually cadence wise, like how frequent were you able to kind of move from your active income to the passive? Like how does that work mechanism wise?
Yeah. And on your first question, are we talking about the first real estate deal I did, the 2-bed, 1-bath house hack? Or are we talking about the first multifamily syndication deal?
Passive investment part.
Okay, got it.
All these active things, and then there must be some sort of transition.
Yeah.
And then the study, because people say passive investment, but it's not really passive. When you're at a 40 deals level, you're not really passive. You're doing a lot of active education. Yeah.
Yep, yep. And so I I launched a podcast in 2020 called The Actively Passive Show, and it's exactly to that point. It's the active components to being a passive investor, right? Because of course, especially it's like anything that you do it one or two times, sure, it's pretty passive, but like a stock trader doing 100 trades a day, well, that's very active.
Right.
And so 2015 is when it all changed for me. This was the big, as I mentioned, when I was 30 days on, 30 days off at home, and I had a lot of time to read. I read 52 books that year. I would say about 80% was allocated towards financial stuff and real estate and things like that. This is also where I started networking with people, on weekends and these groups and these conferences. So I tried to jam pack what would take someone an average of maybe 5-6 years of research into 1 year.
Mm-hmm.
And I don't advocate that people do that. It was information overload. We only retain 10% of what we read, et cetera, on and on. So it wasn't the best use of my time. It was a very ambitious goal that I achieved. But yeah, I would say maybe read 4 or 5 books throughout a year that are dedicated to what you want to do, and then simultaneously take some action, and start pivoting that way. The first deal I did, to answer your question, the first multifamily syndication value add deal I did was with a local operator from a local group. I did the minimum investment, and yes, I was skeptical. It was a new concept still.
Yeah.
And I was just thinking, I'm looking at this overview, this pro forma, and I'm looking at these returns, and I'm going, I don't even make these returns on some of the deals I do actively. And I got to think, this has to be too good. There has to be a catch. There just has to be. So I said, all right, I'm not going to be that much of a skeptic. I'm going to try it, but I'm not putting all my money in this. I'm just going to try it. And so I gave it about 6 months through this learning process where I was selling a deal anyway, a single family home. And I took half that capital and I allocated it to this deal, this syndication. And I wanted to make sure that the monthly cash flow was actually going to come through and hit my bank account, that these monthly reports were going to be accurate and what I thought they were, et cetera, on and on. And I really just fell in love with this model over the next 6 months. And I really started seeing a new path and a bigger picture. And again, my biggest motivation at that particular time was to quit the oil field job. I wasn't going to make it there long term. Even if I had wanted to, I wasn't, because of what we talked about. I'd be laid off anyway. So I had to get out. Oil was crashing in 2015. It was a scary time for everybody. And sure enough, layoffs came. I was able to exit right before that, but I absolutely would have been laid off 100%. So that's kind of what that looked like. So I did my education throughout 12 months for the most part. And of course, I educate every day. So I don't want to make it sound like, like I got a college degree and I never learned a thing after, but
Yeah, definitely.
yeah, but that's what I did. I tried to condense time frames, took some speed reading classes, et cetera, in networking.
Yeah, it's definitely dedicated to the 52 books. Okay, so then after you did the first deal, did you kind of jump into the second deal right away? At what point did you decide like, hey, this is actually working?
Yep. It's a good question. I kind of made myself this agreement that I was going to diversify. First of all, I wasn't just going to take a whole bunch of capital, hundreds of thousands, and go put it into one deal. Yeah. So as my single family homes were selling because they were a flip, or when I had a buy and hold, I had several of those, I would give a notice ahead of time to my tenants and say, hey, in 6 months, I'm going to put this on the market, FYI, blah, blah, blah. And so as those naturally turned over, nothing took, I don't think, more than 12 months, maybe a little bit more to turn over. I put them all on the market. I would sell them. And I tried to be as patient as I could. I'm not that patient of a person, but I just started putting, 50K here, 50K here, 50K here. And I just did all these different deals. And I thought I need to diversify among different operators, different regions. And that was one of the biggest appeals, by the way. When you're an LP in a syndication, you can diversify nationwide. Like today I have LP deals that are in Colorado, Michigan, Ohio, Texas, Florida, Georgia, Carolinas, everywhere. And I like that because you never know. We see these catastrophic weather events and hurricanes in Florida and flooding and freezing down in Houston. And so I like to be diversified that way. And that was one of the things that scared me long term about thinking I had 100% of my equity and portfolio all in single family, all in a 30-mile radius, all in one state. And I was very uncomfortable with that, just myself. And so that's so yeah, it's happened over time. It started in 2015 with this type of investing. I still do it today. I'm still investing in 2021, still invested throughout COVID last year. And, did, I don't even know, 6-7 deals last year. So still very bullish on multifamily value add kind of plays, if anyone's wondering.
And then when you mentioned about diversification, did you so tell us maybe like the worst deal you've done, and then we'll talk about like the best deal we've done.
Well, and there's two stories with the worst. So 80% of my portfolio has been allocated to multifamily class B and C kind of plays. Okay. But I also invest in self-storage and notes and distressed debt and these other kind of models. Now, when I was wanting to diversify perhaps a little too far out, I put a lot of capital relative to my portfolio in this deal that came from an investor group that I thought was just going to crush it. I mean, the cash flow was like 20% plus. It just looked like a home run. Well, part of that ended up being a Ponzi scheme. So I lost almost 40% of what I put into that deal. So that was certainly the worst deal I've ever done in history of any type of investing. And then in the multifamily space, knock on wood, so far, haven't lost money, but I did a deal that had very strong pro forma, very good business plan, good market, good price, et cetera. But the operator really, really dropped the ball, made a lot of bad decisions, hired the wrong contractors, hired the wrong property management companies. And what we thought would be like a 18 to 20% return was more like a 9% return. And so it was a big letdown, but I can't complain too much. I mean, I'm still happy with 9% all in all. But it taught me a lot about the operator and how important it is that anyone showing you a deal, A, it's all projections. Nobody really knows, the answer, but B, can they really pull this off? Have they done it before? How many times? Who are they working with? Who are the partners? Who's the property manager? So you really got to look at the team a lot. I put about 50% emphasis over the team versus the market and the deal. Those are each kind of like 25%, at least to me, just sharing my philosophy and ideas.
So do you now kind of pare down to only invest with a few of the operator? Because you mentioned that you put like 14 sponsors before, but is there kind of like a goal to kind of pare down to, because people are important in this industry, and then use that to kind of diversify maybe geolocations and classes and et cetera?
Yeah, I'm always open to looking at anybody's deal. If anyone wants to send me their deal, I'm always open to that. I'm not going to shut someone out just by saying I only invest over here, period. I think that's foolish. So, but that being said, yes, I've reeled in over the last 24 months, give or take, to kind of taking those 14 operators down to maybe 5 to 7 that have really proven themselves, that have really had good execution, that have great communication with investors, and kind of that under promise and over deliver philosophy. So that's what I've honed into, but not to make it sound black and white. I still invest, by the way, in some people's student deals. I'm a big fan of people getting started and being ambitious, but I do want to know, of course, like I said, who's on the team. Do they have any kind of track record? If they don't, are they working with a mentor or a certain group or something in the space? But and I'll probably just do the minimum investment.
Yeah, definitely. And then, so can you share with us a few tips now, being such a seasoned LP, on picking the right people, picking the right syndicator? Like, is there a read on them? Like, let's just say you're investing in a new syndicator. What kind of read are you kind of looking for?
Yeah, I used to talk a lot about gut checks and things like this, and then a couple people called me out on that, saying, well, I can't read people, or I've hired bad people, and so that they kind of discredit that idea. So what I've kind of come to in a more modernized approach is, what I do is this, and what I teach is this: is you start by identifying your goals. I think that is far the most important thing. What are you really after in your life? Why do you want passive income? Why do you want 10,000 a month? Why do you want blah, blah, blah? Find your actual goals, get as detailed as possible. Then you need to start looking at your criteria. What's going to help you? What kinds of deals help you achieve that goal? For example, someone has a passive income goal every month. Okay. Well, maybe it's value add multifamily syndications that distribute on a monthly basis, blah, blah, blah. And they have a good emphasis on the cash flow and not so much on the equity or something. Okay. For just example purposes, somebody else says, well, you know what? I just want a $3 million nest egg and it's all about equity. I don't need any cash flow. I got a high paying job right now. I'm good. And they just want to retire at 50 with $3 million bucks. Well, they might like hospitality deals, A-class projects, new development, new construction. So you've got to learn about criteria and what exists and what kinds of deals can help you get to your goal. And then you kind of got to, understand what your investing philosophy is all about and what markets you like and what trends are important to you, where companies and people are moving to. And then after all that, that's all before, even networking with sponsors. And then you want to take all that information and start finding the operators who fit as much of that criteria as possible and align with your philosophy as much as possible as well. And so that's been my approach. That's worked very well. Different operators have different mindsets. There was one in 2015. I'll share this story really quick. Really well-known GP, won't name names for privacy's sake. 25 plus years as a GP doing multifamily syndications and raising capital, right? So in 2015, I say, please put me on your investor list. I'd love to do a deal with you, etc. The conversation went, there was three things I remember. We're going to see a massive market correction in 2016. So we're not doing any more multifamily deals for the foreseeable future. And right now we're in the process of selling most of our portfolio. And since 2015, they've done, I think, 2 deals, and they've mostly been sitting in cash on the sidelines. Well, that was a philosophy that I didn't buy into. I didn't agree with that. I'm of the mindset there's always a deal to be had, whether we're in an uptrending, downtrending, or a sideways market. And so I went to other operators that more aligned with what I was looking for, groups like Ashcroft and Joe Fairless. And so that's so important, because how upset would I be, investing with that other group and sitting in cash or something, for 5-6 years. I'd be ticked. So that's kind of my process.
Gotcha. And then how do you pick markets? You mentioned about you picking the markets before you're picking the operator, which is very interesting, and I agree upon. Some people will pick the operator first, and then they're like, whatever the operator goes to the market, we trust their judgment on market. So how do you pick markets before you pick operators?
From a macro level, you got to look at read some news headlines, look at some data, look at the U-Haul stats. I like to look at where people are moving from and for what reason, where they're moving to. So you've got a lot of high tax states right now that are kind of in trouble. You have New York and New Jersey folks that are moving down to the Carolinas, down to Georgia, down to Florida. There's a massive influx. In fact, I just looked it up. The U-Hauls going out to Florida right now are like 4 times the price. It's insanity right now how many people are moving there. So you need to understand that, but you also need to understand what employment is out there and what companies are relocating to those states, what kind of quality of life exists. For example, Texas and Florida have a large inbound migration right now, and they're also tax-free states compared to California. So a lot of folks are moving, companies and people, from California to Texas. So I like to know those. And I also like to look for diversification within the market, within the employment sector. So we all know what happened to Detroit in 2008 and 2009. You're relatively relying on one type or one sector of employment, that's car manufacturing. And when that shuts down, everyone's out of a job. And what's that mean for your apartment building, right? Bad news. So you take a market like, say, Dallas, Fort Worth. I think this still holds true, but there isn't any one sector of employment that comprises more than 20% of the overall market. So you have healthcare, and you have IT, and you have oil and gas, and you have all these different things. And that's important because everything has cycles, and all these industries have boom and bust. So,
right, absolutely. And now, so because you're doing passive investing, but very much active still, because you're actually
Yeah.
doing a lot of research and making sure that you have doing that. So, like what is your 5 year to 7 year goal? Like a medium long term goal, like from here on. Because oftentimes when we reach FI, we kind of have a
Mhm.
reset moment. Um, yeah,
Yeah, well, let me share this first. My vision of what FI is, what financial independence means, is that you have the flexibility to focus more of your time and energy on the things that you love and enjoy doing and less on the things you don't like doing. So the answer would be that every 5 years, I'm sure it's going to change. Okay, right now, what my passion is, and probably for the next 5 years, is to educate, to get on stage, to do podcasts, to help people understand real estate, from a hands-off level and these syndications and whatnot. And I thoroughly enjoy it. I thoroughly enjoy going to conferences and just networking with people, learning. It's just a great environment. But if things change, if I don't know, the markets shift or I start investing in something else down the road, I'm probably going to build up a passion for that. And I'm going to want to share that with people as to why that is. And so I may be taking a new trajectory with it, And another thing is that my wife and I, we love to travel. We're international travelers. And so you just never know, where we might end up living. And that could spawn a whole new entrepreneurial mindset there. Here's what this place needs. It needs this kind of business or whatever. So
yeah,
I'm always open. I'm always flexible, but I intend on, like I said earlier, keeping the long-term vision of being a full-time LP for the flexibility and for the lifestyle until I die, I hope. That'd be my hope. So we'll see.
great, which is awesome. And how does people find more information about, you know, all these years you accumulated experience? I think there's just a wealth of knowledge to share for passive investors.
Yeah.
How does people kind of find more information about you or get connected with you?
Yeah, so many ways. When COVID hit in 2020, around March, April, I went online like I never was before. I never intended to be on Instagram and doing all these things, but I really took a digital move to reach people where I couldn't otherwise, like at an in-person conference. So I launched the Actively Passive Show, which is part of Joe Fairless's best ever real estate investing advice podcast, but it's on YouTube and it's on video. And so I have a co-host there, Theo Hicks, and then some episodes are solo with just me. I have my own YouTube channel, so just go Travis Watts, Watts, and I have a ton of content more about the FIRE movement, frugality, different little 2-minute clips about things like that. Passive Investor Tips is my Instagram and my Facebook. I post a lot of stuff there. I give out discounted tickets to events and all kinds of things. And then LinkedIn. A lot of people connect with me on LinkedIn, Travis Watts, Watts. And on there too is a calendar link if anyone wants to do like a 15-minute Q&A. We talked offline about this before we started. I'm happy to help anybody, and I'm so serious about that. Whether you just want to learn about FI and that movement, whether you got $100 to work with and you're trying to figure out your path, whether you're an accredited investor and you want to do these deals like what I do, I'm just happy to be a resource for anybody. So connect with me there, and just Google me. How about that?
That's amazing. These are great resources, guys. You should probably take Travis up on that, and we'll put that on our show notes as well. Last question we have over here is we always ask our guests to kind of make it full circle. So do you have any children right now?
My wife and I are expecting around January 1, 2022, our first child. So we're having a boy and we're really excited.
Awesome. So with that in mind, do you have some ideas and thoughts on how do you actually teaching your kids to be financially literate, and being either entrepreneur or having that spirit?
I plan on not reading the Dr. Seuss books and reading the Rich Dad Poor Dad books as early as birth, number one. And then hopefully that resonates over time. But it's really interesting. So I have 4 nephews of different ages, all the way from 12 to 18, and I've opened brokerage accounts for them, and this is what I do for them on an annual basis. Is I put several $100s in there, and I teach them about dividend-paying stocks. I teach them about publicly traded REITs, things that are they can wrap their head around at numbers like that. And it's just interesting because every kid is different, and I've got one nephew that's like, he's putting his own money in and he's going, yeah, man, I'm doubling down on this. I want to be just like you. And I've got another nephew that's probably going to pull that money out in 2 years and go buy a car.
Yeah.
It's just not going to work for everyone. It's not a one size fits all. I think you really need to be self motivated, but I'm going to do everything I can to instill these lessons of entrepreneurship, of investing, of passive income, and we'll see how that pans out.
That's awesome, Travis. Well, thank you so much for coming to our show. And we'll put all show notes underneath. That's how you reach Travis. And this wraps up our another show. Thank you so much.
Thank you, Lisa. Thank you, everybody.
Bye.